Hello everybody, Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And I've got a real treat for you today, at least from my perspective, because I've been lamenting as Mr. Valuation, that many of you know me by, that it's been very hard to find good value in this market. I've considered the market to be very expensive and very extended, and I've talked about that in previous videos. And the real key was to find the highest quality companies at attractive valuations that I could find. That's always been my objective and always been my goal. Well, thanks to Mr. Market, I finally got the opportunity to do that with a very nice little company that is a dividend contender. They've increased their dividend for 11 years in a row. They offer a nice 2.44% current dividend yield that has had good long-term dividend growth. And it was overvalued just a few months ago. That's now become attractively valued. So let me introduce you to Snap-on. Snap-on Tool Company. Many of you know this stock probably, that you've seen their trucks riding along on the highways and so on, but they're actually a pretty diversified company. They have all these various brands of tools right here, and they serve all kind of different industries. The electrical vehicle industry, they have adjustable wrenches, they have shops repair even the most damaged vehicles for repair shops. They have the Blue Point Tool Company, which was established in Milwaukee, provides punches and chisels, Car-O-Line, Car Tech, etc. Now they serve also a pretty diverse group of customers, as you can see here. They serve aerospace and aviation. As I mentioned earlier, they have the collision industry, construction and agriculture, electronics, heavy-duty trucks and fleets, manufacturing, medical device manufacturing, medical cutting, military and defense, mining, oil and gas, power generation, and even railroads. So this is a very diverse tool company. Their GICS sub-industry sector is industrial machinery, which, I believe that probably sums it up. But here's what I really like about the company. Number one, it's A- credit rating. I really like that. That's one of the first things I look for. Of course, the first thing I look for is earnings growth. And I want you to note that the company since 2004 has grown earnings at a way above average rate of 13.34%. And they've done it pretty consistently. Now, if I expand this out a little bit, you can see that they did have a drop in earnings during the recession of 2001, which brought their growth rate down to 8.5%. They also had a drop in earnings coming out of the Great Recession here. They had a recent drop in earnings in 2020, but generally speaking, they've been a very consistent producer. But as mentioned, this is a dividend contender with 11 consecutive years of dividend increases. They froze the dividend in 2004 and 2005, but since 2005, they've increased the dividend every year. You can see that as depicted here on the white line, where their dividend has steadily grown. Now, the company only pays out, in the 20% range most years of their dividend. It got as high as 30% and 38% in recent years. But they have a lot of room to continue to grow their dividend. Their dividend payout ratio is relatively low. They only have 23% debt, and it's just got good, consistent results. Now, when I look at the price history of the company, you can see that the price has tracked earnings very nicely. When we did have a drop in earnings, we did see a price drop, and then we saw a recovery. We had a period where the price got overvalued as the market, we came out of the Great Recession, and this is pretty much consistent with the market. But we had a nice big correction that, gave us a great buying opportunity in 2020, and I actually took advantage of that. And then it got overvalued again, and I actually sold it, which was maybe a long-term mistake, but it's turned out to be a short-term benefit because I've got the opportunity to buy the stock again. Now, it was recovering pretty strongly. It had a pretty big drop yesterday, but it's recovering up over almost 2% so far today as I produce this video. But it is attractively valued. It doesn't have the margin of safety it had back here, but again, you can buy it with a 2.44% dividend yield. And the company's historical performance has been very good. They've produced significantly more dividend income than the S&P 500. This is going back to December of 2003 through yesterday's close. The price then was $32.24. Yesterday's close was $202.03. The market only threw off $5,400 in dividends. They've turned $10,000 into $62,000, so it's been a six-bagger over this time, where the market would have grown to 45. That gives them an 11.9% annualized rate of return versus 9.5 in the market. And remember, the market is significantly overvalued. Now, I've talked about that quite a bit in past videos. So even though this stock is now fairly valued and it started out being overvalued, it's really had great, performance. Since it bottomed during the Great Recession, the stock's rate of return has been closer to 20%. So it really does matter. Valuation does matter, and it matters a lot. You can see some, different results you get from different valuation levels. Now, going forward, looking at the company going forward, and I want to spend some time on this because I got some pretty good comments about my frustration with this idea of relying on analyst estimates. I would never rely on analyst estimates. But here's the point. If you're going to invest in a stock, you've got to recognize that although it's great to learn about the company's past and how well they've done, you can't invest in any of this. You can only invest in what the future is going to bring. So if you're going to be a successful investor, I believe it's absolutely imperative, implicit even, that you must have some idea of what the company's going to do going forward. That's really the first step I'm always looking at. I like to say I like to run the numbers out to their logical conclusion. So I start with consensus estimates from the leading analysts that follow the company. Okay, but I don't rely on them, but that's my starting point. It gives me some idea of what the company's growth might be. Now, the forecast for the next 2 years, based on the estimates of 9 analysts, are for about almost 13% growth. Now, first of all, that's reasonably consistent with their historical results that I've shown you here. So that's, one point. That means that I would consider those forecasts reasonable. Number 2 is there is some supply chain issues, and that is including a really good year expected this year. And they just announced earnings, and they beat earnings on both, or their report beat on both earnings and revenues and sales. But there are some supply line constraints that are coming up now. So analysts are only expecting a moderate growth rate next year, and then going back to 9%. The long-term growth rate is expected to be double-digit, about 10%. Now, I like to check these against other estimates as well. And looking at Yahoo expects long-term growth of about 10% as well. And they get their data from Reuters. We get ours from FactSet. So a slightly different, group of analysts, but very similar expectations. Now, analysts get this information from the company. So I want to make some other comments about analyst estimates. Number 1 is this argument whether analysts are always right or always wrong, or you can't rely on analyst estimates is all foolish. You've got to have some type of a forecast. You've got to have some type of expectation about what a company is going to do in the forward, or you're a moron for investing in it. In other words, the only reason I want to invest is because I believe the future is going to be bright, and because I believe I can buy the stock at a great valuation, and therefore I'm going to get rewarded through both dividend income and earnings growth, which will lead to capital appreciation going forward. So I've got to have good valuation, which I have. The stock is trading, currently right at its valuation line. I've got decent growth expectations. I've got 5% followed by 9% for the next couple years. I've got a long-term double-digit expectation, which I kind of like. Now, the first thing I want to do is how much reliance can I put on these estimates? Well, a limited amount, obviously, but I'm going to check the analyst scorecard. Now, what's very interesting, when you measure how accurate analysts have been with a 10% margin of error on a 1-year forecast going forward, in other words, how good have they been? And what I'm really looking at there is how good do I expect this 1-year forecast to be right here? And if I go back to the analyst scorecard and look at it, the analysts have been correct on this company virtually the vast majority of the time. If I use the summary, they've only missed estimates 8% of the time, and they've beat them 17% of the time, and they've hit them 75% of the time with a margin of error. It'd be totally unrealistic and foolish to expect these guys to be perfect. But the point is, this company has proven itself to be reasonably predictable. Even when the analysts are going out 2 years forward, they only missed 17%, and they've hit it 83%. But here's the key. The devil's in the details, as they say. Even with the 2-year forecast, when they did miss, that was during the Great Recession and coming out of the Great Recession, and they did miss by a lot. In 2020, they missed by 15%, and we give them a 20% margin of error for going 2 years forward. But, the analysts were expecting 1338. The actual was 11.6. But in 2019, the actual was 2026, and the analysts were only expecting 11.58, so they beat it by 5.5% there. The point is, are these estimates reasonable? And I would argue that an expectation of 8 to 10% growth going forward on Snap-on is totally reasonable. I can also check their historical growth rates. Okay, and I have this little drop down here. I can look at all the historical growth rates that this company has achieved. And keep in mind now, I've got some relatively low numbers here recently, but that includes the COVID, dilemma. Otherwise, I can see, 8, 9, 10, 14 double-digit returns, or growth rates all along. So I could pick a conservative growth rate like 10%, 10.1% here, apply a 15 PE to that, and I've got a double-digit rate of return expectation. If I'm looking at current estimates, I'm looking at about a 13% return estimate for between now and the end of next year, and that drops down to about 12% going out. But these are nice numbers for an extremely high-quality company with a great track record, with a great, 12-year, 11-year record now of increasing their dividend every year. Now, I like to run these companies through these other pays, but before I do, let me make sure I don't forget to do something else. Estimates are dynamic. On fast graphs, they are being constantly updated. If the analysts change an estimate, we immediately, within 24 hours, will showcase that on the forecasting calculator. And the key word is, this is a calculator. This tool allows you to look at what the analysts are expecting and then point to various different PE ratios out here and do what-if scenarios. What if the company does earn 14.49, and what if it trades at 15 times earnings? That would be my annualized rate of return. Now, that's a big number. It's a 7.5% actual return out to the end of this year. If the PE ratio dropped to, let's say, 12 times earnings, I would be making about 55%. I can do that with each of them. I can run these different PE ratios and run kind of a bad case scenario, an optimistic case scenario, etc. I can do the same thing with the normal PE ratio. I can look at the fact here and see that historically the market has put a premium above my minimum of 15 PE. More recently, it's been a little bit less than that, but I can put these higher PE ratios in here and calculate. So I can run some numbers as to what I might believe I could expect this company to do. But I want to make another very strong point. I also want to see what the trend of estimates have been. And we provide that on fast graphs. 6 months ago, analysts were expecting $13.35, for 2021 earnings. 3 months ago, they raised that to $14.17. The most recent estimate was they raised it to $14.54, and then they've adjusted it slightly down to $14.49. We see similar but better for 2022. They were originally saying $14.20, which would have been a drop actually in earnings. Well, a drop from, the actual what they're expecting today. Then they raise it to $14.60 to $14.90. Now the analysts have raised the earnings estimate to $15.21. And likewise for 2023, it went from a low of $15.30 and has steadily inched up to where analysts are now expecting $16.52. But that can change. But I've got the tool here that I can monitor that. I can check it every day. And if the numbers change, and they do change, I will have access to that. But the key is, all this is my starting point. This appears to look like a stock that is worth doing more comprehensive research and due diligence on. But before I actually make that decision, I'll run it through different metrics. I'm going to look at diluted earnings here. Okay, these are GAAP earnings. Prior to that, I was showing you what they call operating earnings. This has some, accounting convention, non-cash charges, one-time events, etc. I see a very good relationship between diluted earnings, and I see actually better valuation when I look at diluted earnings. This is a dividend payer with a good dividend record. It's an above average dividend yield. So the next thing I'm going to look at is operating cash flow. Now, I like to see the 3 to 5 year trend line for cash flow increasing for operating cash flow, because that's what's going to pay the dividend. But I also want to see this covering the dividend. And you can see their operating cash flows have performed very well over the last 5 years. The growth of about double-digit growth of over 10% on operating cash flow. Now, ultimately, free cash flow is, what's left over after the company has spent the money to run the business and any CapEx. And here, free cash flow has really covered the dividend. Now, it is expected to kind of revert back to a more normal trend for next year. And, when I look at the forecast of free cash flow, it is expected to drop next year, but it still should be covering the dividend. So I feel pretty good about that as well. Okay, moving on, I like to go into fund graphs, all right? And here's the free cash flow numbers that you can see. This is the quarterly free cash flow data that I've just been talking about. And the last 4 quarters have been a little weak, and that can be attributed almost exclusively to these, supply channel interruptions that everyone's worried about. That is an issue for almost all companies across the country. But this is a very well-capitalized company with a great balance sheet, and, it looks really attractive, and I can finally buy it at an attractive valuation. Other things I like to look at is I'm going to go into the income statement here. I like to look at net income. I want to see net income growing. That's, very, very important. I mean, I'm doing this in millions now. So net income has gone from, $421 million in 2014 up to $627 million last year, but down a little bit from 2019. All right, but I see a good positive trend there. When I'm looking at various ratios, like I want to look at profitability ratio, return on assets, I like to see those above 15%. It's 17% for Snap-on. Returns on equity, I like to see above 10%, and it's, consistently above 10%. So I'm, very happy with that. I like to see margin, and I like to see margin expansion. So I've got gross and net margins here holding up real well. I've got gross margins over 50% and net margins from 15 to 18%. So I'm very sanguine about that. The bottom line is this company is, really an interesting company. If you look at Zacks, I went to Zacks here, investment research. So now everything I've seen says I want to dig deeper. So now I start doing my due diligence. All right, I want to make that clear. I don't rely on the analyst estimates. I use them to determine whether or not I should even be thinking about spending more time on the company. In this case, I've agreed that I should. My mind says, hey, this is a great company. You followed it for a long time. It's A-rated, A- rated, great balance sheet, modest debt, good dividend record. Let's see what, let's try to learn some more about the company. So going into Zacks Investment Research, the first thing I see is that the company's most recent quarter, the third quarter earnings report was great. Everything was positive. They were positive on revenues. They were positive on earnings, et cetera. Their margins were improving. They actually improved a little bit, which again, I mentioned it earlier. I like that. The company has good strategies to boost their growth. And the key is they've got a lot of financial flexibility because as I went through this, they've got a really strong balance sheet. And they are friendly in terms of shareholder friendly. They did purchase modest amount of shares, but they've actually been very prudent in that regard. And they usually typically only do it when the shares are inexpensive. And the company's also, got plenty of free cash flow. Their free cash flow yields over 26%, and they're covering their dividend, and they're, committed to that. The reasons to sell, there are some headwinds. Under, the COVID-19 variants that interrupted the supply chain, which I've talked about numerous times already. There's obviously the company does business in over 300 countries, so they do have some currency headwinds that you've got to worry about, against the dollar. Drop in consumer sentiment could impact sales. That's pretty iffy. And then also raw material price volatility could be an issue. But there's a lot more reasons to like this stock than there is to not like the stock. I do really like the fact that it became reasonably valued after being overvalued for most of this year. It has a great dividend yield. It's one that I think you should take a look at if you're looking for, everything. It's got total return potential. It's a good income producer. It's got a great dividend record, a strong balance sheet, nice quality little company. It's only a almost $11 billion market cap, only $11 billion in total enterprise value. So there's a lot of room for growth in this company, and it's really has a great long-term record. Anyway, it's been Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. I actually really like this company because, it is very hard to find a company with this kind of consistency and this kind of quality that you can find at an attractive valuation in today's market. So I hope you find this one interesting. If you liked the video, give me a like, share it with others, ring the bell. And you might also want to take a look at Fast Graphs because, it's a tremendous tool that really identifies the business first and then how the market is valuing that business second so that you can make more prudent decisions, number one, but also so you can even determine whether you want to believe those analysts or not and go ahead and do further research. But there is no substitute for comprehensive research and due diligence. Thanks for watching.